studying your last two. I swim med when turned in. The staring down to mute. And can learn the pole that sunk he died.
When reviewing the accounting records of an owner-managed business, every transaction deserves your attention because every transaction tells a story. Your objective is not simply to determine whether money was spent. Your objective is to understand why it was spent, who benefited from it, and how it should be treated for tax purposes. Experienced accountants never begin by calculating tax. They begin by asking questions. The first question is, who actually made the payment? Was it paid from the corporate bank account, a corporate credit card, or personally by the shareholder? Next, ask who received the benefit. Did the expense help the business generate income, or did it primarily benefit the owner or a family member? This single question often determines whether an amount is deductible or should instead be treated as a shareholder loan or shareholder benefit. You should also determine whether there was a genuine business purpose for the transaction. A purchase may appear legitimate at first glance, but without a valid business reason, it may not qualify as a deductible expense. Supporting documentation is equally important. Receipts, invoices, contracts, bank statements, and credit card statements provide the evidence needed to support the tax treatment of an expense. If proper documentation is missing, the deduction may not withstand a CRA review, even if the expense was genuinely business-related. Once you've gathered the facts, classify the transaction carefully. If it has a legitimate business purpose and sufficient supporting documentation, it can generally remain as a business expense. If it is clearly personal, it should be removed from the expense accounts and usually recorded as a shareholder loan or shareholder benefit. If the facts are unclear, don't guess. Go back to the client and ask for additional information before making a decision. Developing the right professional mindset is just as important as understanding the tax rules. Never assume that a transaction is correct simply because it appears in the accounting records. Verify every significant expense. Ask questions whenever something doesn't make sense. Request supporting documentation. And always follow the flow of money from beginning to end. The most successful tax professionals are not the ones who memorize the most tax legislation. They are the ones who consistently ask the right questions, investigate unusual transactions, and make well-supported decisions based on facts rather than assumptions. Remember this principle throughout your career. Good tax preparation begins with asking good questions, not with entering numbers into tax software. As you review the books of an owner-managed corporation, you'll quickly discover that not every transaction carries the same level of risk. Some types of transactions deserve much closer attention because they are far more likely to contain personal expenses or result in CRA adjustments. One of the highest risk areas is cash withdrawals. When money is withdrawn from the corporation in cash, there is often little information explaining how it was ultimately used. Unless there is clear evidence that the cash was spent for business purposes, it may need to be treated as a shareholder withdrawal or shareholder loan. Corporate credit card payments are another area that requires careful review. It is very common for owners to use the same card for both business and personal purchases. Never assume the entire credit card balance represents deductible business expenses. Instead, examine the detailed statements and classify each purchase individually. Fuel expenses also require additional analysis. Simply purchasing fuel does not automatically make it a business expense. Ask whether the vehicle was used for business, whether mileage records exist, and whether the business use percentage can be supported. Proper documentation is essential. Meals and entertainment expenses should always be reviewed carefully. Ask yourself whether there was a legitimate business purpose for the meeting, who attended, and whether the expense was reasonable. Personal dining or social events generally do not qualify as deductible business expenses. Travel expenses can be equally challenging. Airfare, hotels, and transportation costs may be legitimate if they relate directly to earning business income. However, vacations combined with business activities require careful review to determine which costs are deductible and which are personal. Home office expenses deserve similar attention. Confirm that part of the home is regularly used for business, and ensure that only a reasonable portion of household costs is claimed. Overstated home office claims can attract unnecessary CR scrutiny. Large purchases should also be investigated. Ask whether the item is a business asset, a capital asset that should be depreciated over time, or simply a personal purchase incorrectly recorded in the business accounts. Proper classification affects both the financial statements and the tax return. Finally, pay attention to recurring transfers between the corporation and the owner. Regular transfers without a clear explanation often indicate shareholder drawings or loans that must be properly accounted for. A useful way to think about transaction risk is to follow a simple progression. If a transaction appears routine, perform your normal review. If something seems unusual, request additional documentation. If questions remain unanswered, discuss the transaction with the client. And if the explanation still doesn't support the deduction, consider whether a CRA adjustment may be necessary. The most important principle to remember is this: the greater the personal benefit received by the owner, the greater the tax risk. By focusing your attention on these high-risk transactions, you can identify potential problems early, make appropriate adjustments, and significantly reduce the likelihood of reassessments during a CRA audit. This slide summarizes the professional review process that experienced accountants follow to determine the correct tax treatment for every transaction. Rather than relying on assumptions, they use a structured decision-making process based on facts, documentation, and the tax rules. The process begins with one simple question: does the transaction have a genuine business purpose? If the answer is no, the amount is generally not a deductible business expense and should instead be considered as a shareholder benefit or a shareholder loan. If the transaction appears to have a business purpose, the next step is to verify the supporting documentation. Receipts, invoices, contracts, bank statements, and other records provide the evidence needed to support the deduction. Without proper documentation, even a legitimate business expense may not survive a CRA review. Once documentation has been verified, consider whether the expense is reasonable and appropriate for the business. The Income Tax Act generally requires that business expenses be incurred for the purpose of earning income, and that they be reasonable under the circumstances. If an expense fails this test, it may need to be reclassified instead of remaining as a deductible business expense. This is why experienced accountants never rely solely on what the client says. A client may confidently state, "It's a business expense," but professional judgment requires verification. The appropriate response is always, "Show me the supporting documentation." Good documentation tells the real story, while missing receipts, vague descriptions, or unexplained cash payments often indicate that further investigation is needed. After gathering all the facts, compare the characteristics of the transaction. A legitimate business expense benefits the company, is necessary for business operations, is reasonable in amount, has a valid business purpose, and is supported by adequate documentation. In contrast, a personal expense primarily benefits the owner, lacks a genuine business purpose, may not be reasonable, and often has little or no supporting evidence. These expenses are generally not deductible and should instead be treated as shareholder loans or shareholder benefits where appropriate. Following a consistent review process also means adopting good professional habits. Review every transaction individually. Never rely on the account name alone. Verify all supporting documents. Determine who actually benefited from the expense. Apply the CRA rules consistently, and document every adjustment that you make. The ultimate goal is not simply to complete a tax return. It is to produce accurate financial statements, prepare a correct tax return, protect your client from unnecessary reassessments, and protect yourself as a tax professional. Careful classification today prevents penalties, reduces audit risk, and leads to better outcomes for everyone involved.